Money is supposed to be neutral. That's what we're told. Medium of exchange, a store of value, a good tool to make trade easier. But what if that's the lie? Populations. Because throughout history, something strange keeps happening. Whenever societies face unrest, inequality, or collapse, the same response appears again. And again, not with soldiers, not with tanks, but with asterisk financial decisions, currencies are altered. Credit is tightened, prices rise without explanation, savings vanish quietly, debt multiplies silently, and the public is blamed. You worked hard, you followed the rules, you saved responsibly, yet somehow you're poorer. So here's the uncomfortable question this video is about, greater than asterisk. What if money itself has become a weapon, not against enemies, but against the people who use it every day? Asterisk, not accidentally, not temporarily, but systematically. Don't understand this? We have to go back to the beginning. To the moment money stopped being a shared tool and became a mechanism of control. For most of human history, money wasn't powerful. It was boring. In early civilizations, money emerged to solve a simple problem. Barter doesn't scale. Can't trade goats for grain forever. So societies used shells, metals, tallies, objects that represented value. Crucially, asterisk money was constrained asterisk. Coins were hard to produce. Gold and silver were scarce. Rulers couldn't simply create more without consequence, which meant power was limited. A king who debased his currency too aggressively triggered inflation, revolt, or collapse. Roman emperors learned this the hard way. The silver content in Roman coins declined, trust collapsed, and so did the empire. For centuries, money acted as a leash on authority. Until that leash was cut, the real shift didn't happen with coins. It happened with asterisk paper, asterisk. At first, paper money was just a receipt, a claim on something real, gold stored somewhere secure. But over time, rulers noticed something dangerous. Most people never asked for the gold, so why not issue more paper than gold? This wasn't framed as deception, it was framed as efficiency. Banks could lend more, trade could expand, economies could grow, and for a while it worked, until wars arrived. Wars are expensive, and wars revealed the fatal temptation. Asterisk, if money could be created. Wars could be financed without immediate public resistance. Asterisk, no new taxes, no direct pain. Just inflation, slow, invisible, deniable. This is when money quietly changed roles. It stopped being a neutral medium. It became an asterisk policy lever. Asterisk central banking didn't emerge to help the public. It emerged to stabilize asterisk states asterisk. When modern central banks formed from the Bank of England to the Federal Reserve, they were sold as guardians of stability, independent, technocratic, above politics. But independence didn't mean neutrality. It meant asterisk distance from democratic accountability, asterisk. Interest rates became tools. Liquidity became power. Access to credit became conditional. And here's the key shift. Greater than asterisk economic pain became a strategy. Asterisk raising interest rates doesn't just slow inflation, it slows hiring. It increases unemployment. It weakens labor bargaining power. That's not a side effect. That's the mechanism. Because a population worried about survival is easier to manage than one confident enough to demand change. Every monetary system eventually faces a breaking point. For the gold standard, it was rigidity. For fiat money, it's excess. When money can be created without limit, it eventually must be used to solve political problems. And that's when it turns against the public. Look at the patterns. Inflation spikes after financial crises. Asset prices rise faster than wages. Debt becomes permanent. Not temporary austerity always follows expansion, the public is told. This is necessary. There is no alternative. You lived beyond your means. But notice something strange. Governments never seem to run out of money for banks, or wars, or bailouts. Scarcity only appears when it's time to help ordinary people. That's not coincidence. It's targeting. When inflation hits, it doesn't hurt everyone equally. Debtors with assets benefit. Creditors rewrite rules. Those closest to money creation get first access. This is called the Cantillon effect. New money enters the economy. Somewhere banks, financial markets, government contractors, and only later reaches wages. By the time it does, prices have already risen, which means greater than inflation is a transfer. Not a mistake, not a natural disaster. A transfer from savers to borrowers, from workers to asset holders, from the public to the financial core. And it happens quietly enough that no one calls it theft. Every crisis produces promises: better regulation, fairer taxation, more transparency. But structural reforms never touch the core issue. Who controls money creation? Because the system relies on imbalance. If money were neutral again, governments couldn't hide costs. If money were constrained, wars would be unpopular. If money served the public, power would have to answer to people. So, reforms target symptoms, never the weapon itself. Today, money is more powerful than ever, not because it's physical, but because it's programmable. Interest rates move markets instantly. Central banks signal expectations like commands. Digital currencies promise efficiency and surveillance. Imagine money that can expire. Money that can be restricted. Money that can be frozen with a keystroke. For the first time in history, money doesn't just reflect behavior. It can enforce it. And once that system exists, it will not only be used in emergencies, it will become normal. Look back across centuries and the pattern is clear. 1. Money starts as a tool. 2. Authority centralizes control. 3. Crises justify expansion. 4. Costs are socialized. 5. Control tightens, the names change. The currencies change. The structure doesn't. Takeaway 1. Money is not neutral. It reflects power structures. Takeaway 2. Inflation and austerity are political tools, not accidents. Takeaway 3. When money becomes abstract, accountability disappears. And the warning? Society that doesn't control its money will eventually be controlled by it. The open question isn't whether money can be weaponized. It already is. The real question is, greater than who decides when it's aimed at you? If you found this breakdown useful, unsettling, or clarifying, consider subscribing. This channel exists to explore the systems we're told not to question. Because the most dangerous weapons aren't always loud. Sometimes they're numbers on a screen.